2008 wasn't just the year the iPhone and Apple's App Store changed the world, nor was it simply when the Beijing Olympics showcased global unity and the election of Barack Obama brought hope and change. It was also the year our economy nearly collapsed. As we look back on the Great Recession, we see the end of an era and the beginning of profound economic and social shifts. Over $10 trillion vanished from global stock markets, and the ripple effects of that year are still felt in our economic policies and personal finances. But how did it all happen? And more importantly, how does it still impact us today? Before the 2008 economic collapse, the global economy seemed solid. The housing market was booming, unemployment rates were low, and consumer confidence was high. Banks and financial institutions were thriving, fueled by an era of deregulation that began in the late 1990s. However, beneath this facade of prosperity, dangerous practices were taking root. In the United States, household debt surged from $7 trillion in 2001 to nearly $14 trillion in 2008, setting the stage for a massive financial collapse. This precarious foundation, masked by apparent economic success, would soon lead to one of the most devastating financial crises in modern history. At the heart of this looming disaster was the housing bubble, inflated by risky lending practices and the widespread issuance of subprime mortgages. Financial institutions, driven by short-term profits, dramatically relaxed lending standards and extended risky loans to individuals with poor credit histories. These loans, often made without proper scrutiny of the borrower's ability to repay, were designed to maximize immediate returns at the expense of long-term stability. Between 2000 and 2007, the volume of subprime mortgages soared from $130 billion to $1.3 trillion. Financial institutions capitalized on the booming housing market, and they began bundling these high-risk subprime mortgages into complex financial products known as mortgage-backed securities, MSB. These MSB were sold to investors around the world as low-risk, high-reward investment opportunities. The assumption was that the housing market would continue to rise, and even if some homeowners defaulted on their loans, the overall performance of these securities would remain strong. However, this was a dangerously flawed assumption. The subprime mortgages that had been issued were often of poor quality, with adjustable rates that would eventually increase, leading to higher monthly payments for borrowers. As the housing market began to cool and home values fell, many homeowners found themselves unable to keep up with their mortgage payments, leading to a surge in defaults and foreclosures. The value of the mortgage-backed securities plummeted as a result, exposing the fragile foundation of the financial system. This financial house of cards began to collapse in 2008, setting off a chain reaction of failures and crises across the global financial sector. Lehman Brothers, a prestigious investment bank with over $600 billion in assets, declared bankruptcy. Merrill Lynch was sold at a fire sale price, and American International Group required a $182 billion government bailout to survive. These events sent shockwaves through the global financial system, freezing credit markets and causing stock markets to plummet by over 50% in many countries. In the face of total economic collapse, governments around the world had to act swiftly to prevent further disaster. They introduced massive bailouts and stimulus packages to stabilize the financial system. In the United States, the Troubled Asset Relief Program injected $700 billion into the financial system. Central banks slashed interest rates to near zero and implemented unconventional monetary policies like quantitative easing, which increased the Federal Reserve's balance sheet from $900 billion to over $2 trillion. These measures stabilized the financial system, but also sparked debates about moral hazard and long-term consequences. The immediate aftermath of the 2008 financial crisis was devastating. Unemployment rates soared as companies cut jobs to survive. In the United States alone, over 8.7 million jobs were lost between 2008 and 2009. The housing market crashed, leading to millions of foreclosures. By 2010, approximately 10 million homeowners had lost their homes due to foreclosure. Families were uprooted, and personal savings were wiped out. The economic scars ran deep, and the recovery was slow and uneven. with some people never fully regaining their financial footing. Beyond the economic devastation, the crisis also led to a significant erosion of trust in financial institutions, governments, and the economic system as a whole. People felt betrayed by the entities that were supposed to protect them. This disillusionment fueled movements like Occupy Wall Street, which protested against economic inequality and corporate greed, and also led to greater political divisions. The lingering distrust has influenced everything from voting patterns to consumer behavior, reshaping the social fabric in many countries. The combination of economic hardship and loss of trust underscored the need for significant policy changes to build a more resilient economy. What if another crisis like 2008 strikes again? In the wake of the financial meltdown, sweeping changes in economic policies and regulations were made to prevent such a disaster from happening again. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 was introduced to curb the risky behaviors that had led to the crisis, including the Volcker Rule, which restricted the banks from making certain speculative investments. While these regulations aim to create a safer financial system, there is still debate about whether they are strong enough. Meanwhile, central banks kept interest rates very low for an extended period to support economic recovery. Although this helped stabilize the economy, it also led to new issues like asset bubbles and increased income inequality. These mixed results highlight the ongoing challenges and adjustments in economic policy following the crisis, showing how the events of 2008 continue to shape our financial landscape. Let's dive deeper into the enduring impacts of the 2008 financial crisis and explore how it continues to affect you today. 1. Wealth inequality. Not only did the Great Recession rock the global economy, it also widened the gap between the rich and the poor. As the recovery unfolded, the wealthiest 1% of U.S. households saw their share of total wealth grow from 29.5% in 2007 to an astonishing 34.4% in 2016. This significant growth in wealth concentration was a reminder of how economic downturns can disproportionately benefit the wealthy while leaving many others behind. This growing inequality has sparked ongoing social and economic tensions and debate about the need for comprehensive policies aimed at fostering economic fairness. The economic hardship and inequality that emerged during this time fueled political polarization, leaving a lasting mark on political discourse. 2. Labor market changes. In the wake of the crisis, companies slashed labor costs by shifting to gig workers instead of maintaining traditional full-time positions. This shift in employment practices was driven by a desire for greater flexibility and reduced overhead costs. Consequently, more people turned to gig work to navigate economic uncertainty. This dramatic shift reshaped job security and workers' rights, as gig economy roles often lack the benefits and protections of traditional employment. Additionally, the prolonged economic instability led to long-term unemployment for many workers, causing skill erosion and diminished future job prospects. A 2015 report from the Federal Reserve Bank of New York found that workers who experienced long-term unemployment during the recession faced significantly lower wages and fewer job opportunities in the years following the crisis. 3. Housing market instability. Despite extensive efforts to recover, housing affordability remains a major, unresolved issue. Home prices have since rebounded and now exceed pre-crisis levels. In 2023, the U.S. housing market was marked by soaring prices, making it increasingly difficult for first-time buyers to enter the market. For many prospective homeowners, the dream of owning a home remains out of reach due to high prices and competition. Renters are also feeling the strain, as increased demand from institutional buyers has led to higher rents and reduced rental affordability. 4. Student debt crisis. The financial strain led to a significant increase in student loan debt as more individuals sought higher education as a pathway to economic stability. U.S. student loan debt now exceeds $1.7 trillion, and over 44 million borrowers are affected. This overwhelming debt burden has profound implications for economic mobility. Many young adults face delays in achieving milestones such as homeownership, as a substantial portion of their income is diverted to repaying student loans. 5. Ecological impact and generational shifts. The 2008 crisis may have left the deepest mark on millennials. Growing up during the Great Recession exposed them to high unemployment, market crashes, and institutional failures, which fostered a deep skepticism towards traditional financial systems. This experience led some millennials to favor renting over buying homes. Their mistrust of conventional investments has also driven them towards alternative assets, with 43% of millennials investing in or trading cryptocurrencies by 2021. They are also heavy users of digital financial tools, with 82% utilizing fintech solutions like peer-to-peer lending platforms, reflecting their preference for innovative and transparent financial services. 6. Fiscal policy and national debt. To fight the economic downturn, governments also increased spending. This led to a significant rise in national debt. In the US, debt nearly doubled from $10 trillion in 2008 to over $20 trillion by 2017. High debt levels limit future fiscal options. This could mean higher taxes or reduced public services, and poses challenges for long-term economic stability. 7. Financial regulation and oversight. In response to the crisis, financial regulations were greatly increased to prevent a similar event in the future. New institutions like the Financial Stability Oversight Council were established in the US. Their goal is to monitor systemic risks. However, debates continue about these measures. Some argue they reduce risky behavior. Others believe they hinder economic growth and innovation. 8. National impacts. The crisis had major international repercussions as well, disrupting global trade and investment flows. Emerging markets faced financial instability and capital flight, draining billions from economies that were already struggling. In response, nations increased efforts to cooperate on financial regulation and strengthen the resilience of the international financial system. The crisis highlighted the interconnectedness of the world economy and the need for coordinated policy responses in addressing global economic challenges. Building on these experiences, the 2008 financial crisis has influenced how governments and financial institutions prepare for future crises. Lessons learned led to more rigorous stress tests for banks, stronger risk management practices, and a push for greater financial transparency. The COVID-19 pandemic put these measures to the test. While challenges persist and the financial system remains imperfect, the improvements made since 2008 have contributed to a more resilient global financial system, better equipped to handle future crises. The Great Recession was a pivotal moment that reshaped the global economy and left lasting scars. Understanding its causes and consequences is crucial for navigating today's complex economic landscape. As individuals, staying informed and reflecting on these lessons helps us to build a stronger and more resilient future. If you found this video insightful, don't forget to like, subscribe, and hit the bell icon for more deep dives into the truth about money and the disruptions of capital. Thank you for watching.